Welcome to the eBSI Export Academy's International Trade Specialist Program. 42 video courses designed to boost your global trade skills. In this course, Methods of Payment in International Trade, you'll discover the safest and fastest ways to get paid for exports, pros and cons of various payment methods, and how to choose the right method for each transaction. Ready to go global? Let's begin. In this learning unit, you will learn about the various methods of payment and the differences between them as used in international trade. This will be achieved by outlining a definition of an international trade sale, explaining what a method of payment in international trade really is, examining how to receive and effect payment for international contracts of sale, analyzing the various methods of payment in international trade, and finally, we will learn about collections and the difference between clean and documentary collections.
Welcome to this video version of our International Methods of Payment course. In this unit, you will cover the various methods of payment, including the personal check, bank draft, bank transfer, clean collection, documentary collection, countries and payment terms, bank payment obligation. You will notice we have not included documentary letters of credit, as these are covered in detail in 2 separate course units. So let's begin. Screens that include interactive elements that cannot be accessed in this video format and are only available in the full interactive version of the course. You can upgrade to the video version through the link in the description.
An international sale is a commercial transaction between parties of different countries in which goods or services are exchanged for economic consideration. A method of payment in international trade is a mechanism that facilitates the trade and payment of goods and services between parties from different countries. Classification of methods of payment. Imagine that you are an exporter who has an export opportunity with a buyer or importer in Turkey. How are you going to receive payment for this transaction? There are various methods of payment for international trade transactions. Firstly, we could classify them as advance payment. The exporter receives payment before the delivery of the goods. Deferred payment. The exporter receives payment after the delivery of the goods. Payment with control over the goods. The exporter keeps title to the goods until he obtains payment. We can simply classify methods of payment as clean payments or documentary payments. Here we will examine a simple overview of documentary payment processes. Criteria for the choice of a method of payment. What criteria do we have to bear in mind in order to select a method of payment? The principal criterion is the level of trust and credit history between the exporter and the importer. The level of trust and credit history will be crucial when selecting a method of payment. If there is a trustful relationship between the exporter and the importer, a simple and economical method of payment will be chosen. When dealing with new importers or buyers, a more secure method of payment should be negotiated. Interact with this page to learn more.
Screens that include interactive elements that cannot be accessed in this video format and are only available in the full interactive version of the course. You can upgrade to the video version through the link in the description.
Factors affecting the importer's and the exporter's choice. Here we will look at some of the key factors which affect the exporter's and importer's choice of method of payment. The exporter ships his goods and receives payment having negotiated the most secure method of payment from the importer. As in domestic trade transactions, the importer undertakes to pay the amount in exchange for the goods or services which the exporter provides in compliance with the contract as agreed. All the cases mentioned above are described in terms of competitive markets where the exporter needs to sell his goods. When there is trust and good faith in the relationship between the exporter and the importer, they select a method of payment that is connected neither to the physical movement of the goods nor the documentation that enables one to obtain title to the goods. The exporter will directly provide the importer with the documents needed to customs clear the goods, and the importer will effect payment by a bank transfer, bank draft, check, or by commercial credit card, which is becoming more popular. Many exporters starting export activities seek to compete in a new market offering more attractive payment terms, but at a risk. This policy may become extremely dangerous for two reasons. The risk of payment default is high, and it will be difficult in the future to change the method of payment when liberal payment terms have been first agreed. Therefore, caution should be taken when deciding on payment terms when entering into new markets. This conflict of interests between the exporter and the importer can be solved or facilitated through the services of a bank, which acts as an intermediary. In practice, international transactions will involve two banks, one offering international trade banking services to the exporter and the other offering international trade banking services to the importer. It is important to deal with a reputable bank in international markets. An important aspect to consider when choosing a bank for this purpose is that it has a large network of foreign correspondents abroad. Receiving payment for bad debts. Collection agencies. Collection agencies offer services to obtain payment from bad debtors. They diligently exert pressure on debtors to obtain payment. Collection agencies belong to associations and have codes of ethics which regulate their activities. The process involves locating the debtor, negotiating the payment terms, or reducing the amount to be paid, or agreeing stage payments, and possibly recovering the goods that have not been sold or used in production. The strategy of collection agencies is to try to strictly enforce the payment terms that have been agreed. This may even lead to damaging the reputation of the debtor. The cost of debt collection services can be agreed in several ways. Deducting a certain percentage of the sum recovered, it may also be fixed by the agency providing the services, or it may depend on how the debt was recovered. Click through to learn more about credit risk insurance. Analysis of methods of payment. The chart shows the most common methods of payment in international trade, from a personal or company check, which offers minimum payment security for the exporter, to the documentary credit, which offers maximum payment security for the exporter, other than payment in advance, of course. This chart is only for reference. The analysis of each method of payment will be covered in later sections. Note that the more security the exporter seeks, for example with a documentary credit, the more it will cost. Click to view the chart.
Screens that include interactive elements that cannot be accessed in this video format and are only available in the full interactive version of the course. You can upgrade to the video version through the link in the description.
This graphic presents a general table as an overview of methods of payment used in international trade. Other methods of payment for export. Payment in cash guarantees that goods are delivered only when payment is received. Cash must be stored securely, counted and possibly converted into the national currency. Due to these logistical difficulties, this method of payment is rarely used in international transactions. Payment direct into the exporter's bank account is common in open account sales and in cases of regular and frequent deliveries. If the method of payment is cash on delivery, the importer pays when he receives the goods from the carrier. The exporter can sell his foreign debts to a factoring company. The factoring company collects the sums due from foreign debtors and, when value is received, pays the exporter after deduction of the agreed fees. If the foreign importer defaults, the factoring company still has to pay the exporter. This is covered in a later learning unit. Payback. In case of a sale of machinery or technology transfer, it is possible to receive an amount of whatever was produced with this machinery or technology. This method of payment is called payback or buyback. In weaker economies, for example in trade with developing countries, non-monetary methods of payment, such as payback or buyback, can be of great importance. Non-monetary methods of payment. In countries that have insufficient funds to finance their import requirements, other non-monetary methods of payment are used, for example, countertrade. This has resulted in big industrial corporations setting up their subsidiaries, trading companies, in order to sell the goods obtained in these transactions. Sometimes the transaction may even involve 3 or more parties. Countertrade is a system where goods are exchanged for other goods rather than money being paid. There are 2 main types of countertrade. 1. Balanced or full barter. No transfer of funds takes place, the value of goods imported and exported are equal. Or part barter. A transfer of funds is required to balance part of the barter. Payment by check. A check is written out by a person or company, organization, and is drawn on their bank account. Interact with this page to learn more.
Screens that include interactive elements that cannot be accessed in this video format and are only available in the full interactive version of the course. You can upgrade to the video version through the link in the description.
Bank drafts. A bank draft can be drawn by a bank on itself or drawn on its account with a foreign bank. The difference between a bank draft and a check payment is that the bank draft is issued by a bank against a current account in foreign currencies that the issuing bank has in another correspondent bank. A bank draft offers higher security of payment than payment by check. Interact with this page to learn more.
Screens that include interactive elements that cannot be accessed in this video format and are only available in the full interactive version of the course. You can upgrade to the video version through the link in the description.
Bank transfer. The importer instructs his bank to issue against his account a bank transfer in favor of the account of the exporter with a foreign bank. Disadvantages for the importer. This method of payment can be expensive for the importer due to the costs relating to the issuing of the message. These costs must be paid by the importer to his bank. Disadvantages for the exporter. Revocability. A payment order may be revoked or cancelled until the value date, normally 2 working days from the date of issuing the payment order. Interact with this page to learn more.
Screens that include interactive elements that cannot be accessed in this video format and are only available in the full interactive version of the course. You can upgrade to the video version through the link in the description.
Hi there. I really hope you're enjoying the course content. We worked hard to create a video version of our interactive course that's available on our online campus. If you're finding it of benefit, please like and subscribe. It'll help us spread the word to others who may be interested. We really appreciate your spending your time with us here. Thanks.
Documentary payment order. The processing of a documentary payment order is similar to a clean payment order. In the case of a documentary payment order, the importer requests his bank to issue a payment order in favor of the exporter and make it effective only against the presentation of documents to the exporter's bank. Advantages for the importer. The importer has more security than the exporter, because the exporter will obtain payment only if he presents the necessary documents previously agreed on. Normally, these documents are ones which evidence the delivery of the goods to the carrier and state their destination. Documentary payment order. Disadvantages for the importer. Firstly, a documentary payment order does not allow one to delay payment. Secondly, it is not subject to the international rules. Sometimes banks issue irrevocable documentary payment orders. However, one must have in mind that this method of payment is not subject to any international legislation or rules. The only guarantee that the exporter has is the issuing bank itself. Thirdly, a documentary payment order is revocable. The importer may cancel it as long as the exporter has not presented documents to the bank and received payment. The importer is in the hands of the issuing bank because it is the issuing bank who decides whether or not to pay against the documents. Nevertheless, if the importer clearly specifies the documents to be presented and the issuing bank offers sufficient guarantees, this risk is minimized. Clean collection. Clean collections involve sending financial documents, such as bills of exchange or promissory notes, through the banking system in order to collect payment from the importer. These documents are not accompanied by commercial documents, such as invoices or shipping documents. The goods and documents of title to the goods are sent directly to the importer. This method of payment is only used when there is a certain level of trust between the exporter and the importer, because the exporter loses documentary and physical control over the goods before receiving payment. Interact with this page to learn more.
Screens that include interactive elements that cannot be accessed in this video format and are only available in the full interactive version of the course. You can upgrade to the video version through the link in the description.
Documentary collection. According to the ICC definition, A documentary collection is a bank operation initiated at the client's request involving financial and/or commercial documents aimed at acceptance and/or payment against these documents and release of these documents in compliance with the terms and conditions agreed. The difference between a clean and documentary collection is that in a documentary collection, the documents which represent the goods are transferred through the banking system. This assures the exporter that the importer will access the documents only when he complies with the exporter's instructions for the collection, documents against payment, or documents against acceptance. A documentary collection gives the exporter more payment security than a clean collection. Interact with this page to learn more.
Screens that include interactive elements that cannot be accessed in this video format and are only available in the full interactive version of the course. You can upgrade to the video version through the link in the description.
Documentary collection. There are two types of documentary collection: documents against payment and documents against acceptance. Documents against payment, or DP. In this type of a documentary collection, the importer's bank releases the documents to the importer when he makes payment. The commercial documents do not necessarily have to be accompanied by financial documents. In the event of non-payment, and if the documentary collection contains instructions on protesting, protest action can be carried out effectively. However, if a clause on the protesting is not included, it cannot be applied. Documents against acceptance, DA. The importer's bank releases the documents to the importer against the acceptance of a financial document, which accompanies the commercial documents. The importer's bank will handle the financial document according to the instructions specified in the documentary collection. Keep until the expiry date or return to the exporter's bank.
Okay, we're close to the end of the lesson. If we haven't done so already, please like and subscribe, and if you have any questions or comments, feel free to add them in the comments section below.
Countries and payment terms. In this section, we're going to present short notes on the characteristics of different countries. These comments are of a general nature and in no case can be considered as hard and fast rules or instructions. Read through this section to gain a general rule of thumb for each region concerned.
Cribus D&B is a highly specialized company with advanced business information skills. It was set up with the aim of providing both the Italian market and D&B's global clients with the highest standards of quality in terms of business coverage, the depth and accuracy of information, the technological capacity and flexibility to respond quickly to market demands, as well as in the provision of decisional systems and scoring models. The data presented in this study come from the information held in DuneTrader program and are elaborated by Cribus D&B. In particular, payment assessment is based on the analysis of those companies for which a D&B Paydex value is available, where D&B Paydex is a statistical indicator that assesses the historical performance of payments to suppliers and provides a reliable profile of a company in terms of whether or not it is a good payer. The D&B Paydex score is only generated if there are at least 3 trade experiences from 3 different suppliers. This is because it is an indicator that enables the average payment practices of clients to be assessed and requires the identification of a trend and homogeneous observations, guaranteed by the use of a clear and correct definition of payment experiences.
Understanding the payment behavior of potential customers in foreign countries is vital. Assumptions of poor assessments can lead to major problems in financial planning due to the significant impact posed to both large and small companies by poor payment practices. For the Atradius Payment Practices Barometer, businesses are asked to evaluate the payment practices of their domestic and international business partners and their company's credit management in general. Click to access the Atradius Payment Practices Barometer website.
Given the importance of this subject, we have compiled a series of in-depth resources for your further reference. 1. International trade, cost and efficiency of selected payment instruments. 2. How banks affect export patterns. 3. A study of international trade. Finance practices. 4. Trade finance in times of crisis. 5. A summary of the methods of payment. This course includes a number of additional resources, including the examples above. You will be able to access them if you sign up for the full course at the link below. You can find this link also in our description and pinned to the comments below. Discuss this unit. When you sign up for the full certificate course, you will be able to discuss this unit on the forums to clarify any queries or comments you may have.
In this unit, you learned of the differences between the various methods of payment in international trade. You also examined the different criteria involved when choosing a method of payment, analyzed the two different types of documentary collection, and examined the different payment terms and characteristics of various regions throughout the world.
Thanks for participating in this online video course. The paid version of this program includes more interactive content, supplementary materials for download, forums, an online test, and certificate award. If you would like to achieve this course certificate, then follow the link in the description below or in the pinned comment. Don't forget to like and subscribe, and if you would like to binge all 42 course units, here's the link to do so. You'll find it also in the link below.